Today we are looking at UNP, Union Pacific Corporation, currently trading at $193.10. I'm going to run through why I'm currently buying up shares of Union Pacific, and then I'm going to take a look at the dividend safety, run through lots of financial metrics about the company, and we're going to end the video, as always, running through our stock valuation system, finding out our intrinsic value and what our acceptable buy price would be using our margin of safety. Now, before we get into the video, smash the like button if you are loving these videos, smash the subscribe button to keep them coming, and let's jump straight in. So year to date, the stock is down 7%, and if we take a look at 10 years, we can see that overall the company is up 149.77%, just purely on shareholder price appreciation, and this does not include reinvested dividends. The current starting yield of 2.69% is quite nice in my opinion, and as we can see, it is trading towards the 52-week low of $183. And then now let's jump into the actual metrics of the company. So we can see that the score of 88 for Union Pacific is very safe, and we can see that the market cap is 118 billion, so therefore it's a mega cap. Now we're going to run through these other pictures here. Now, this one we're going to run through, but I think it's a few things I just want to show you. In the recession, if we do enter a recession, it maintained its dividend during 2007 to 2009, which is positive. Recession sales, however, was a negative 21%, which was below the average growth rate during this period. However, it did beat the S&P 500 of negative 55% return from that period with a negative 42%. We're going to run through these very soon, but as we can see, these are quite low for most companies, and this we will jump into as well. So one thing I do love to see is when a company grows that dividend in double digits. Essentially, if a company is increasing their dividend by 4%, that effectively is saying it's keeping in line with inflation, as inflation over the last 30 to 40 years in the US was 4%. So 18% in their last increase is very, very good, and their 20-year dividend CAGR of 17%, meaning on average it has grown 17% the dividend over the last 20 years, is very, very strong. 16 years of consecutive dividend increases is also very nice, so lots of positives. Now, one of the reasons why I'm investing, as we can see here from dividend yield theory, it is showing that UNP is currently undervalued. Dividend yield theory states that whenever the yield is above the 5-year line, which we can see here is 2.11%, then the company is undervalued, currently at 2.69%. However, as always, as I say in my videos, we do never look at anything in isolation, and essentially we look at lots of different metrics and valuations. Again, the forward PE, as we can see here, is below that 5-year average of 16.8, so that also shows us another sign of undervaluation. As we can see here, the sector PE is roughly in line with the industrials at 16.8. And one thing I do like to do is normally buy stocks at a 52-week low or near enough to that 52-week low. Again, this doesn't necessarily mean that because it's near the 52-week low, it's going to go back up to the 52-week high. But for me, it is one metric that I like to look at when I'm looking at undervalued stocks or potential undervaluation of them. Moving on, earnings payout ratio and the free cash flow payout ratio. I love to see the free cash flow payout ratio, as earnings is susceptible to manipulation. But again, for investors that do like to see these figures, I've got them on the screen. As we can see, over the last 10 years, it is below 60%, which is what I like to see, and it's actually below 50%. So what this means is there is room to grow that double-digit dividend growth. Again, the free cash flow payout ratio is the same. Over the last 10 years, bar 2015, it's below 60%. So for me, that's a very strong sign that Union Pacific are able to continue growing that double-digit growth. Now, an additional metric that I've put in from those who have been watching my videos regularly is the earnings per share and free cash flow per share. You know, with this, obviously you want this to be increasing, and from 2013, the EPS has gone up from 4.71 to 11.2, so that's very strong, nearly 3 times over the last 10 years. And likewise with the free cash flow per share at $3.59 in 2013 to 22 of 9.2. So for me, this is very, very positive. You might look and say year by year it hasn't gone up. If you're looking, you say, oh, in 21 and 22 it's gone down slightly. But as a long-term dividend investor, I look for periods of at least 5 to 10 years. And for me, looking at these over a 10-year period is showing positive signs. Now, sales growth, as we can see here, typically we look for steady moderate growth of 3 to 7% across the years, and we can see for the large part, whilst this has been positive, there have also been years of a negative growth. Now, total sales, again, likewise, as we can see over the period from 2013 to 2022, hasn't grown significantly. There's been about 10% in growth. However, we do like to see a bit more of an increase. So this is one probably negative where I would say that I'd keep an eye on for UNP. Now, shares outstanding. This, in my opinion, is a gorgeous graph. As we can see from 2013 down to 2022, it's been nearly a third reduction in their shares outstanding, which is essentially returning excess cash to shareholders. So for me, this is a very strong green flag, essentially, as shares outstanding decreasing at this rate is very good for shareholders as we are getting the excess cash. It could either be through shares outstanding and the company buying back shares or through dividends, but so far it looks like UNP are doing both. Great dividend increases and buying back shares. Return on invested capital, I like to see anything above 10%, and as we can see here, they have been doing pretty well. All 10 years have been above 10%, and in 2022, 16%. For me, that is a very good sign. Again, free cash flow margin, operating margin, above 12% on the operating margin, above 5%. I won't spend too much time, but we can see that they have done significantly well in that respect and have continued to do so throughout the years. So another positive. Finally, net debt to earnings before interest, tax, depreciation and amortization. This basically saying if we look at 2022, it would take 2.71 years for the company to pay off all of its debt net of cash on hand. Again, we like to see below 3, and while this is increasing, it is below 3, but definitely something to take a look at as the years go on, as we want to make sure that it is below 3, which is our preference. Now, net debt to capital below 0.4, so we want around 40% of the company's financing to be from debt rather than equity. As we can see, it has been increasing in line with this on the left. So again, one thing to note as their debt is increasing, and it's not something that we want to see for a company, as that could be a worry. But again, so far so good, but something just to keep in mind over the years. Now, stock valuation, we want to understand what is the price, what is the intrinsic value of UNP, and let's start with our first valuation model. Graham's valuation model, I've done a video explaining this and running through so you can create your copy. Do go check that out, but let's jump straight in. Earnings per share $11.07, growth rate in line with analyst estimates of 10, and we've inputted the current yield on AAA corporate bonds, which is 4.67. So Graham's valuation, the intrinsic value for UNP is $177.31, which we can see here is significantly lower than the current trading price. Moving on to our second model, the multiples valuation, we put in companies that are in the similar industry, sector and size as UNP. We have Norfolk Southern, Canadian National Railway, Canadian Pacific and Old Dominion Freight Line. We input the stock price, input the earnings per share, and this gives us our P multiples. We then get the average of these multiples and we multiply that by the earnings per share, giving UNP a multiples valuation price of $222.97, so upside to the current trading price. Then we move on to the dividend discount model and we input the yearly dividends for UNP over the last 5 years with an average growth rate of 11.4%. On a forward-looking basis, I've gone a bit more conservative at 6%, as I like these videos to be on the more conservative side. And this gives us a DDM price of $220, again upside to the current trading price, and again I used a conservative figure. Now finally we get to the discounted cash flow model and the free cash flows I've inputted over the last 10 years. We then get our growth year on year, an average growth rate of 7.4%. On a forward looking, I've gone with 7.4%, which is essentially in line with the last 10 years, as I don't see there being much change currently. And this gives us our future free cash flows, and then using our discount rate here we get our present value of these future free cash flows and the terminal value. We then get the sum of our future free cash flows, add the cash and cash equivalents, subtract the total debt and derive our equity value. We then divide by our shares outstanding to get a DCF price of $180. Now before we move on to the intrinsic value, smash the like button if you're enjoying the content and smash the subscribe button if you aren't already subscribed. Now, we've just run through these 4 models. We have the prices here, And what we're essentially doing with the intrinsic value is getting the average, which is $200. I'll just show on the graph here that is a slight increase on the current trading price. Now, the current price is $193.10, and before we look at our margin of safety, Wall Street price forecasts have estimated the price to be $219 within the next 12 months. Now, margin of safety, typically I'd be buying around a 10% margin of safety. It really depends on your risk climate, but for a company like UNP, where I believe there to be limited barriers of entry, as you know, there aren't that many companies that can come into this sector, I would give this a margin of safety at around 5%. So for me, particularly in this company, I would be picking up shares around $190. So as the stock price has been dropping, I have been picking up shares and will continue to do so if it reaches 190 and starts to drop below. Now, those who have a more risk appetite, they may be looking at the current price of $200 and be looking to buy at the current trading price. Again, if people do not have that much of a risk appetite, at 10% you'd be looking to buy at around $180, and we can quickly see that this has that is just slightly below the 52-week range, where the low was $183. Again, thank you for watching the video. Do smash the like button, do smash the subscribe button, let me know your thoughts in the comments, and I will catch you on the next episode. Have a lovely day.